Well, hello there, Melissa. Happy Monday to you. We typically meet on Friday, but time got away and life happens. And so we're doing it on Monday today. So really quickly, just want to ask, where are rates at right now? I know a couple weeks ago we were in the mid sevens. So where are we?
We're at the average rate locked on a conventional loan in America right now is 6.98 on conventional. FHA and VA are at about 6.5, so a little bit lower. So we're in one of those markets where conventional rates are actually higher than FHA and VA. So it happens sometimes. This is one of those times.
What causes that?
I'm not sure, honestly. I don't know if it's the fact that conventional loans have a higher likelihood of prepaying more quickly, but I actually think it's the opposite. So I'm honestly not sure.
Interesting, yeah. Because I always thought conventional was typically lower, but lately I've seen just what you said, FHA and VAs are actually lower. I was just curious what triggers that. Okay, so this week is not much has happened in the market. We're pretty stagnant, pretty stable right now, right around the 7%, it looks like. But this week is a big week for us. Again, the Feds meet this week. You said Tuesday and Wednesday with the announcement for most likely the rate increase, the Fed fund rate increase on Wednesday. So let's talk a little bit about that. What are you guys expecting?
So we're expecting a 25 basis point increase or a quarter percentage point. So, and the market, there's a 94.6% likelihood that that's going to happen. So it's pretty close to 100%. Now, what the market is hoping is that this is the last time they do one of these increases. Now, back in May, the market got a little spooked because inflation numbers were trending in the right direction, but they said based on the core inflation numbers that they were going to do 2 more increases. So since then, we've really only had good news on inflation and good news on the job front in that the economy isn't creating a massive number of new jobs that would be inflationary on income, which then leads to inflation in prices. So basically all the news has pointed to inflation really is going down, even though that core number that they now like to look at is not, it's a little bit more stubborn. So we are optimistic that this will be the last 25 basis point increase or quarter point increase. Fingers crossed. We don't know for sure, but that's what we're hoping.
Yeah. And so after right about this time last year is when people took a step back and we're like, yeah, we're not buying. We're going to wait till the bubble burst. And, us, you and I and other realtors and lenders were all like, no, wait, it's not going to happen. We're very confident it's not going to happen because rules, regulations have changed. We have things in place. So it's clear the bubble is not bursting. We are still seeing right now how home prices are back up to where they were last year. So they dropped for those couple months, but they're right back up. And we're level. The market is starting to slow because we're getting into the school year. Buying season is almost over. We're seeing less homes on the market, more buyers, but again, the bubble did not burst. Thank God. It's clear it's not going to happen. So
no, there's literally zero evidence that is going to happen.
Yeah. And so really quick, I keep getting calls I hear interest rates are going to go up again. And I'm trying to educate all my buyers and clients that the Fed fund rate is different than mortgage interest rate. So why don't you talk a little bit about that?
Yes. So
again,
the federal funds rate is the rate that banks charge each other for overnight loans. So this is short-term lending, which a lot of the economy, it's very necessary for the economy to have that. And it also does trickle down to other interest rates, but it's more likely when you go into a bank and the rate that you're going to get is the prime rate plus 2%. It's much more closely tied to that prime rate than it is to mortgage rates. Now, mortgage rates do go in correlation usually with it, but just because the rate is going to go up by a quarter percent on Wednesday, or that's what 94% of the people think is going to happen, does not mean that mortgage rates will go up, because the mortgage rates have priced in this expectation for the last at least 30 days. So what would change things is if they don't raise rates a quarter point. Let's say they raise rates a half a point. That would be a surprise, and that would cause mortgage rates to go up. Now, if they came back and they said, we're only going to raise it an eighth of a point, well, then mortgage rates would probably drop because we're expecting a quarter point. So it's the difference in expectation really that causes a change in mortgage rates. Does that make sense? Hopefully. Oh, you're muted.
Yeah, it definitely does. The biggest thing is that it has a correlation, but it does not necessarily affect interest rates. Interest rates stay exactly where they're at.
And I think the correlation happens so much earlier than people realize. So the people pricing mortgage-backed securities have been anticipating this for at least a month, maybe two, close to two.
That's May.
Raise rates in anticipation of it, rather than waiting for it to happen.
Okay, thank you for that explanation. I know we've talked about it over and over again, but it just keeps coming up, and it's not easy to understand, so.
No.
Layman's terms, thank you. Okay, so you also said, while we were talking, that Friday is another big day that may lead to a little bit of volatility in the market.
Yeah, so there is some economic news coming out towards the end of the week that, again, if things come in higher or lower than expectations, they come in higher. So if we're expecting a number to come in at 50 and it comes in at 52 for inflation, then we could see mortgage rates go up, because then again, there's the concern that the Federal Reserve is going to have to raise rates again. Now, if they come in at 48 instead of the expected 50, then that means that inflation is trending down faster than anticipated. And then you could see rates go down, mortgage rates go down. Because if you look at a lot of the technical aspects of how mortgages are priced, you could argue that they're higher than they should be based on the 10-year treasury, for example. So the spread between them has really never been this high. Our rates should not be quite as high as they are. So there is room for them to come down. They just need a compelling reason to come down.
Right.
Good economic news, meaning inflation is coming under control, will push them down.
And I think inflation right now is like at a 3.8%, and we're still trying to get to 2%. And we started at what, 9%?
Yeah. So we've made massive progress.
I mean, that's huge in a year, I think is.
Exactly. And if we can get there without causing a recession, that would be a pretty impressive feat, honestly, which is what it looks like is going to happen right now.
Yeah. It's been economics and financial folks have been saying that there's a way for us not to hit a recession. And some people think that we've been in a recession, but
yeah, depending on how you define it, maybe we have, but this doesn't feel like a terribly bad one.
Yeah. So, okay, well, I guess we'll wait to see what happens this week, and maybe on Friday we'll have a good news. I guess what time is the meeting on Friday with the feds that, the announcements come out?
So the big announcement will be Wednesday, 2 o'clock,
okay, right.
2 o'clock Central. And then let's regroup on Friday and see how things have shaken out. How they shook out.
Words together. Yeah. Okay, Melissa. Well, thank you so much for your time today. And I look forward to chatting with you on Friday to see what happens this week.
Absolutely. Sounds great.
Have a good week.
You too. Bye.